Good morning, Jeff. Well, I think what we've heard yesterday is yet more confirmation that this is a US administration with no fear of spending and no fear of debt. It's been clear, really, since day one of the Biden administration that they are focused on supercharging this economic recovery. They moved through that first stimulus package very swiftly, and now clearly attention is turning to infrastructure. But I think the numbers that we're hearing yesterday, clearly there are records being struck here, but they should come as no surprise, because this administration is focused on doing what it takes, spending whatever they think is necessary, and they're not worried about inflation at the moment. They're not worried about doing too much, rather they're worried about doing too little. So I think for me, the biggest upside risk to inflation over the years to come is very different to the situation post the financial crisis, where you have governments that are willing to spend for much, much longer, rather than going back onto the brakes once they feel like the economy is back on track.
Has the bond market lost its ability to frighten politicians into curbing their fiscal excess? And I ask that because we did see the yield curve rise yesterday, I think, on the back of these reports. But at this stage, the politicians that want this kind of money don't seem to be too concerned about debt servicing costs.
Well, I think it shows you really the really close collaboration that you've had between governments and central banks over the past 18 months. Because it's not so much that the bond market can't on its own, it's rather that the Federal Reserve and the QE purchases that they're making are limiting the ability of the bond market to react to fundamentals. So this is why there's so much focus on this tapering discussion, because at the moment, the Fed have Treasury yields on a pretty tight leash. The market just can't fully price these kind of moves when you know that there is this wave of central bank demand coming month after month. So I think as we move through the summer, I'd be expecting the Fed to be ready to at least talk about tapering either at Jackson Hole or at the September meeting, with then an announcement to come by the end of the year and tapering to begin in early 2022. So I think as we're moving through the summer, I would expect yields to be rising further, the yield curve to be steepening further, and perhaps bringing the bond market slightly closer in line with the fundamental picture of the US economy today.
Hugh, the inflation side of the debate, again, well versed. What about the job side of it as well? I mean, I see so much contradictory evidence on an almost daily basis. Industries really struggling to find people, and yet we still apparently have 8 million jobs that aren't there, that were there before the pandemic as well. Is the Fed possibly misreading the tightness of the labour market?
I think there's a real risk there, yes, because the two are inextricably linked. So far, I think it's been quite easy for the Fed to look at that last CPI print and say, well, you've got 2/3 of that rise coming from used cars, from hotels, from airfares. These are all parts of the economy that the Fed have found it quite easy to dismiss as a transitory factor so far. What would give them a real headache is wage growth. And I think when you dig through the labour market data that we've had over the past few weeks and last couple of months, really, there has been a clear tone of inflationary pressures coming from the labour market. Even that big payrolls miss that we had a few weeks ago, that was an inflationary labour market print. And so for me, one of the key things to watch over the next few months is the extent to which we start to see wages rise. You've had a pickup in measures such as the reservation wage, the amount that a job changer would be willing to take, the income that they would be willing to receive in order to switch jobs, has really surged for the low income brackets of the population over the past 12 months, given some of the unemployment enhancement benefits that we've had, for example. So wages, I think, are going to be one of the clearest signs that actual inflationary pressures are building in the US economy, rather than just this one-off effect. And that would put the Fed in a much more difficult position.